Hello, everyone. Welcome back to another episode of Signal or Noise. It's episode 69. Charlie Bilello here, and with me, as always, Peter Mallouk. If you're watching this on YouTube, take a quick moment, hit that subscribe button for all the latest content from us. We're also available on Apple and Spotify. Peter, probably no surprise what we're going to talk about today, the fog of war. I want to read this quote from Karl von Clausewitz, sums it up here. War is the realm of uncertainty. 3/4 of the factors on which action in war is based are wrapped in a fog of greater or less uncertainty. A lot of uncertainty today. Not a big surprise with any type of war you see uncertainty, but so many questions today, Peter. Way more questions than we have answers. I'm just going to run through some of the questions here that we don't have answers to. How long will the war last? Will it expand into a regional war? What's going to happen with the Strait of Hormuz? Will the U.S. send ground forces? Will Russia or China intervene? What are the actual objectives here? What's the end game? And what will the economic costs and consequences be? I know there's a lot in there, Peter, but in terms of uncertainty here, this seems like we've been doing this podcast for 3 years now. It seems like the most uncertainty that I've seen in those past 3 years, right up there with the tariff situation a year ago.
Yes, I mean, nothing the market likes less than uncertainty, and it's been fascinating to watch the markets generally hold up through all of this. But when you think about all of the uncertainty with this, because you have trade, oil, a nuclear power in the region involved. I mean, it's a war that, even if you leave the United States out of it, it's a war that is impossible for Israel to totally lose because it has nuclear weapons, right? And so you're really looking for a situation here where the uncertainty dries up fast and this thing reaches a rapid conclusion. But right now, every day seems to bring relatively new surprises, and the quick end that Trump signaled initially, very early on, he's changed his language around repeatedly now.
For sure. And I think that the answers to most of these questions really hinge on what is the end game? What's the objective here? Because if the objective is to destroy their military capabilities, we seem to have made the case that that's already been done, but yet the war is still ongoing. So then the question is it regime change? And to me, in order to enact that and have it be lasting, you need to send troops on the ground. Now, we haven't said we're going to do that, but we also haven't said what the real objective here is.
Yeah, when Trump's asked directly about that, he said he won't say. But we do know that Trump cares a lot about two things. One, elections, and two, markets. And the second you put a boot on the ground, the uncertainty dramatically expands. The odds of a total disaster go way, way up. And the odds of the market suffering and the midterms not going well go up significantly too. So I'm hopeful that's not where it's going. But you're right. I mean, originally it was like, hey, he was saying he's going to kill everybody and declare victory. Well, they immediately just got replaced by more people of the same regime. I don't think they're going to get regime change here. When you look at everyone talking, I've not found someone who is saying that yet on either side of the aisle, pro-war, anti-war, Democrat, Republican. You're just not seeing anyone say regime change is going to be possible without boots on the ground. So I'm hopeful that he's just going to say, hey, we diminished capabilities, declare victory, and move on.
So I want to lay out 3 scenarios here, Peter. You tell me which one you think is most likely. Of course, it's impossible to predict here, but we have a short, contained conflict. That's the most hopeful outcome, of course. That would be most similar, in my view, to the Gulf War, where it very quickly, it was a broader coalition, so a lot of differences, but it was over within a few months. The second scenario is a prolonged but contained conflict, similar to the Iraq War. They thought it would be short, and it didn't end up being very short, but at least it was contained. And then number 3, you have a wider regional escalation, which is also a longer conflict, similar to the Vietnam War, where you have countries like China getting involved. You have Laos and Cambodia being involved as well. So 3 different scenarios here. Of course, there's a million different scenarios, but I laid out 3 here. What do you make of the situation today? Is there any way to predict which of these 3 is actually going to be what actually happens?
I don't think anybody can predict anything. I'm very, very hopeful for number one. You could argue though it's already expanded according to what's being released by the U.S. We now have supposedly Russia and China providing intelligence to Iran and satellite imaging and targets. I mean that's a big escalation if that's true, and a widening of the conflict. It's already spilled over into surrounding countries too. And so you can feel it moving on to number two or three. But I am very, very hopeful that Trump is going to find an off ramp and say, "Look, we've accomplished what we want to accomplish, and we can just move on."
Yeah, absolutely. But the difference is clear from last year in terms of last June. There was the 12-day war, which ended very quickly. But during that war, there wasn't a retaliation from Iran to the other Gulf states. And this time there has been. So it's already, as you said, bringing in some other places where we have bases in these other countries. And they've been responding to our attacks in Iran with attacks on those bases.
Yes, I think that and you've got also, Israel and Lebanon, not Iran with the Gulf states, as you mentioned. I mean, we're seeing, and Trump calling the European countries and China to join in the Strait. I mean, it's just, you can see it a lot of ways. It can get to a much, much more sustained, expanded conflict. But again, crossing fingers and holding out hope that's not the case.
And ultimately, it is within our control to end this sooner rather than later. And I think when you look at the public support for this, it seems to be the lowest, Peter, that we've seen since World War II. Just looking at the various military engagements here, 41% support for this war. That's the lowest we've seen in other wars here. Iraq was actually at 76%. Persian Gulf War was 82%. World War II, 97%. So I guess the question, we have the midterm elections coming up. Is this pressure going to mount in terms of people saying we don't want to be involved in that, and that might lead to a shorter conflict?
Well, I do think you're seeing more and more voices come out opposing the war. We saw the director of was it counterterrorism that releasing a letter on his resignation. Tulsi released a letter basically saying, it felt like very washing my hands of this, letter. You're seeing more and more dissent, and this has been only going on a few weeks. I don't think Americans have an appetite for this to go on much longer.
And they're not really calling it a war, but it is a war. And so they're saying it's just a short military engagement. It was why they don't need congressional approval. But if this drags on, do you see that potentially ending this sooner? If this drags on longer than people want, eventually Congress gets involved and say we have to authorize this?
I don't think Trump cares what Congress says. I think he's been pretty clear about that.
Yeah, he might not care, but I guess if the Constitution still holds, they would have the power, you would think, to end this. But so far, that resolution hasn't passed. They tried to put it through. There wasn't enough votes to even get a vote on the war, but we'll see what happens there. So many different scenarios, Peter, but clearly an unpopular situation. If you looked at what the number one really issue for most Americans coming into this, it certainly wasn't Iran. It certainly was the lack of affordability. And we're going to talk about in a little bit the impact it's having on gas prices and inflation. So really, it only makes that situation worse. So I want to talk about oil, consumers, and the stock market here. First, oil. It's a little bit confusing for people because we really only talk about oil, Peter, when it's going up. And usually the implication is that oil rising, bad for the stock market, oil down, good for the stock market. But when you dig into the data, that's not actually the case. If you go back to 1984, when crude oil futures started trading in the early 1980s, and I looked at every year, what has crude oil done? What has the S&P done? We actually see higher returns for the stock market, up 12.7% per year when crude oil is up versus when crude oil's down. Now, stock market's done very well when crude oil's down too, up 10% per year. But I think it's confusing for people because they think higher oil is bad. What they're missing here, Peter, is that when oil is up, the economy tends to be good. And really, the concern is not that oil is higher or lower, it's how much higher over a short period of time. And we've seen oil go from less than $60 a barrel entering the year to around $100 a barrel as we're recording this podcast. If we look at the spike over the last 2 weeks, 47% increase in the last 2 weeks. And with the exception of 2020, which was really a rebound after a crash, that's the biggest 2-week spike that we've ever seen.
That's right. Very big spikes are what's negative. When you have modest increases, it shows increased demand, which is an indication of a strong economy. You also have to separate out the markets from Americans. Okay, the majority of Americans, well, every American feels oil prices one way or another. The majority of Americans, it's a significant cost for them. It works its ways into goods and services and everything that's delivered and filling up your car, obviously. So while stocks might be doing great, working Americans are going to feel it a lot more. And again, Trump just cares about two things, the markets and re-election, a lot, right? And so if you have sustained higher oil prices, it will really diminish it will hurt the consumer. In fact, just a couple of days ago, the administration, they said, well, this is negative for the consumer, but that's the least of our worries right now. Now, I know that they did not mean to say that sentence, but they did. And I mean, the indication that they've said out loud over and over again is, hey, this is going to go away in a few weeks. Don't worry about it. And they need it to go away in a few weeks, certainly no longer than a few months, because you get too close to the election, it'll be a real issue.
Yeah, when you look at this chart, what really comes to mind is one other period of time, and I would draw the parallel to around 1990, August 1990, Iraq invades Kuwait. We get involved militarily. We saw a big spike in the price of oil. There was actually a mild recession. That wasn't the only reason for the recession back then, Peter, but you did see the spike in oil leading to a spike in gas price, and consumer spending declined, and we had a mild recession. And if this drags on, one could imagine something similar happening, because we see this spike in the price of gas at the pump here. We've never seen anything like this, Peter. I look back the last 30 years. We're essentially saying a month ago we had average price of gas in the U.S. $2.92 per gallon. Today, $3.84 a gallon. That's over 30% in 1 month. We've never seen that with data going back the last 40 years.
Yes, and this is actually the thing that has me the most convinced that the war will reach a conclusion in a few months, which is it's not the United States, it's not American sentiment, it's not the Gulf states, it's not Israel, it's not Iran, it's the re-election campaign. And if we get too close to the re-election campaign with issues like this still at the forefront, there will be a big change. And I think that is the hourglass. That's the sand going through the hourglass that gives me hope that we're going to reach a conclusion here quickly.
The impact on the equities market here is kind of stunning, and we touched on this. This was going on before the war, but it seemed like the markets were anticipating something happening here. We saw prices of crude oil and gasoline rising in advance of this, so someone maybe had advanced knowledge, or the odds of this happening were increasing. But we have energy stocks, Peter, up 29% year to date due to that rise in crude oil. So certainly there are companies that are benefiting from this within your portfolio. You also have utility stocks up 10%. But on the flip side, the more cyclical sectors are getting hit. We got tech, consumer discretionary, and financials. And really, the consumer discretionary one, down 7%, is the big one for the U.S. economy, because over 70% of economic growth comes from consumer spending. So if you're going to fill up your gas tank this week and you're spending 30% more than you did a month ago, well, that's less money you're going to have to spend at a restaurant, to travel, for other things. So that's how it translates to the actual economy. The spike in crude oil leads to a spike in gas prices and less money in your pocket.
And the performance of these sectors there's a lot of noise here. I mean, part of it is exactly what you're talking about, which is oil prices, the war, and all of that. Part of it is Is it a natural sector rotation like we regularly see from U.S. to international, or large to small, or growth to value? And the third part is the impact of AI. We started to see AI really hit tech stocks, particularly those that were selling software as a service, as a subscription based service, where people are worried about AI really impacting those multiples, and seeing people move to sectors that are less susceptible to disruption from AI, like energy. So there's three major factors really driving the change in which sectors are performing the best.
That's right. It's never just one thing. And today you have not just the situation in Iran, you have fears about private credit, which we'll probably talk about on the next podcast, but that's driving financial stocks lower. So you have a number of different things going on in markets, as always is the case. And today, Peter, there's take your pick. The market's only down 5%, but you got the war in Iran, the crude oil spike, private credit turmoil, AI disruption fears. But to me, looking at this, Peter, the most shocking thing is it's only 5% off of the
Yeah.
high.
I mean, it's absolutely stunning how resilient this market has been, and the total lack of volatility we've seen for, how was it, all the way back to the little tariff spat that happened at the beginning of last year. The market does not seem to want to pull back, no matter what, no matter how many reasons you give it. It has been incredibly resilient.
And is that because the market is betting that this is going to be short lived? I mean, that's would be my interpretation.
Well, I think there's a lot going on. I think, one, it thinks it's going to be short lived. It definitely does not think that you're going to see Russia and China come into this, or that it will expand into the Gulf states, or that it's going to go on for 6 months. That would be a very different pricing in the stock market. It also thinks the impacts of AI will impact certain sectors, but probably help others. And at the end of the day, it looks at the whole thing and says, unemployment is low, earnings continue to grow. That's all we care about. Ignore everything else.
Okay, so and this chart could look very different, to be clear, by the end of this week or next week. We're certainly not saying that the correction won't be bigger from here. It's just a stunning observation that it's been only 5%. We had a bigger correction, Peter, last October, November,
Right.
and the only thing was AI bubble fears. So
We're very overdue for just a normal correction. And for that to happen, the market has to drop at least 5,000 points more, just to have one that happens every 12 to 18 months. We're just overdue for something like that.
okay, let's talk about the impact on inflation, interest rates, and Fed policy here. So crude oil, gasoline, Peter, the past few years have been a tailwind for CPI. They've been steadily trending lower. We had gas prices below $3 a gallon. We had crude oil below $60 a barrel. All that's going to change when we get the March CPI report next month. The reason for that is now you have these big spikes on a year-over-year basis. Crude oil up 48%, gasoline up 43%. We also have this situation that not a lot of people are talking about. I think it's going to get more attention if this drags on here, that fertilizer prices are once again spiking. We saw this back in 2022 with the Russia-Ukraine conflict, but now we're seeing it again because about a third of fertilizer supply actually crosses through the Strait of Hormuz. So it's not just oil, it's fertilizer. That feeds into food prices big time. And so 35% increase over year, we're going to start to see that show up in inflation when we get the print next month. And if you ask consumers, they're expecting it. They're the latest University of Michigan survey. Consumers are expecting inflation to go up. They're expecting gas prices to continue to go up. And this is going to feed into, Peter, interest rates, of course. Before the war began, we had the 10-year slightly below 4%. Now it's around 4.3%. And break-even inflation rates are moving higher as well.
Yeah, I mean, it's just, I think that this is, over the course of the coming year, we're going to see a couple different rate cuts. I don't think we're going to see one today, but I think in the coming months, we're going to see a few. But for the most part, I think we're going to see rates stay in the general rate. They're not going to move meaningfully higher or meaningfully lower. And I think inflation is going to continue to be higher than expected. It is interesting to look at, over the long run, what AI may do to the inflation rate. Will it really drive prices down the way Elon Musk and people like him say? That is the really big wild card that could change everything.
Oh, I certainly hope so. But that will have to be weighed against, of course, how much of a deficit we're running, how much national debt. As you mentioned, the Fed is meeting today. They're not going to cut interest rates. They're not likely to cut in April. And now here's the shift, Peter. The market was predicting 2 interest rate cuts at the start of the year, and now they're only predicting 1 not to happen till the end of the year. But of course, this is all dependent what happens in Iran, what happens with crude oil. As we always say, it's only predictive really in the short run. So Fed's not going to cut today, but all eyes will be on what are their projections going to be for the rest of the year. What is the cost, Peter, of this war going to be? It's not going to be insignificant if this drags on. We've already seen estimates of around 16 billion in the first 12 days of this conflict. Some people are saying it's going to cost about $1 billion a day. And there's no talk whatsoever that I've heard of raising taxes to fund this war. It's already, as we outlined earlier, an unpopular endeavor. If you tell people are going to raise taxes to fund it, I don't think they're going to be very happy about that, which means, of course, that it's going to have to come from borrowing more money. So we ran $1 trillion deficit in the first 5 months of this fiscal year. And when we get that March statement from the Treasury, this defense spending is likely to spike higher.
And really the bigger issue is just the overall monumental deficit spending that exists independent of this war is just so damaging to the future prospects of the US economy that there's going to have to be something independent of this war that creates a deficit that is much, much smaller that the United States has some hope of growing out of. What we know now, the deficit spending, it's impossible for the United States to grow its way out of this. You can grow your way out of the debt if you can control the deficit spending, but there's no end in sight. No end in sight under Trump. There was no end in sight under Biden, both of them just shattering records for spending more money than's coming in.
So the best we could say is deficit likely to widen further as long as this continues. In terms of estimating the cost, we need to know how long it's going to last, of course, to predict that. I would just note that the predictions about the Iraq war back then were way off. They were predicting 50, 60 billion on the outset in terms of the total estimated cost. It ended up being 3 to 4 trillion, Peter. And all of that came from borrowed money. And it seems like that's going to be the case today, which to me means upward pressure on interest rates and inflation going forward. So let's talk about the short run versus the long run, what investors should be thinking about. In the short run, Peter, everyone wants to know, what has the stock market done in the past following military conflicts? And I put together this chart, but I have to put like a million caveats and warnings and saying, please don't rely on any of the data here because every military conflict is different. This is only one input in terms of the stock market of what's driving forward returns. And I don't want you to look at this and say, the stock market's usually up over the next year, 3 years, 5 years. That all of that is true, Peter. But I don't want you to think that it's because of the war or that means necessarily it's going to be the case this time around.
Yeah, it's impossible to predict. This is an example where putting the historical data in the chart is not, it's non-predictive completely. I agree, because every war is very, very, very different in terms of who's involved, how much money is spent, how long does it go on. I would agree with you. I wouldn't put into any stock into this at all.
And so I think this chart is more instructive, which is to say that in the short run, anything can happen. The market go down 20, 30% at any point in time. We always say that, and even more. We've seen 250% declines in the last 25 years. Given enough time, another one of those will happen. But if we go back to World War II, Peter, we go back to 1941, $1 in the S&P 500 with dividends, and we fast forward to today, it's a 12,000x increase over that time, in spite of, not because of, all of these military conflicts that I'm highlighting here on this chart.
That's right. It's much easier to do what you're doing here with this chart, which is to zoom out and just ask the question, am I going to pay more for a can of Diet Coke or to go to McDonald's or to go to Disney World 5-10 years from now than today? Will their earnings go up 5 or 10 years from now versus today? Much easier to get a yes answer there, independent of not just all the wars that are happening as indicated on this chart, but everything else that is happening too.
So it's going to come back to earnings, Peter, for this year and for the long run. For this year, incredibly, and maybe this is why the market's held up so well so far, the expectation is earnings are going to continue to grow and you're going to get mid-teens earnings growth this year. And perhaps until investors see an actual impairment from higher prices for oil and different input costs and something, or consumers pulling back, they're going to assume that this growth is going to continue.
At the end of the day, the only thing the market cares about is earnings. Earnings seem unstoppable. The core of the market is very, very strong. You just can't get away from the fact that almost everyone that wants to work is working, and that these companies are finding ways to drive earnings quarter after quarter after quarter. And at the end of the day, that's all the stock market cares about.
And this chart illustrates that in the long run, 98% correlation, Peter, regardless of what happens in the short run. And certainly if we go into a recession, we're going to see a dip in earnings. But every recession in the past we've had a recovery from, all wars eventually end. And then it comes back to, well, what is this company earning?
That's right. At the end of the day, only factor that matters is earnings. Everything else is really people asking the question, will this impact earnings? Tariffs, will they impact earnings? Oil prices, will it impact earnings? War, will it impact earnings? But the only thing the stock market cares about is future earnings.
All right, great place to end. Thank you, everyone, for joining us on Signal or Noise. For watching this on YouTube, quick reminder, hit that subscribe button for all the latest content from us. And Peter and I will see you next time on Signal or Noise.